All eyes are on the CPI print. The other eyes are on the meeting with Biden and McCarthy to see if they can figure out a solution for the debt ceiling. But you know what? Those things are out of our control. What is in our control is our portfolio is heading into a recession, and that's what we're going to talk about today. So before we jump into that, hit the like button, subscribe to our channel if you haven't already. Nothing Kevin or I say is financial advice. We are not financial advisors. We're a few guys who are trying to navigate the markets, enjoy talking about it, learning about it, nerding out. So do your own research before you make any buys or sells. Kevin, the markets are boring. No surprise there. We were expecting this from the stock market. The three major indices are all down between 0.5% and 0.06%. So really just flat across the board. We're seeing that in crypto as well. ETH and BTC down slightly, but it's less than 1%, which is extremely boring for the crypto streets. So it's a good day for us to kind of talk about how we would plan or how we are planning our bear market, our recession portfolios, because that is a big thing to be focused on right now, in my opinion.
Yeah, absolutely. And I think in some ways the move has already been made. We're kind of in this position where it's like, okay, we're getting closer towards what could potentially be the worst part of this. Again, that would be the bottom of the market. But it seems like after we hit that 31K, at least for crypto, we're starting to see some downward price action. And again, in TradFi, we keep seeing resistance to that 34 for the Dow, for NASDAQ, that 13 level, and then S&P obviously the 42 level. So we're starting to hit major resistances where the price can't really push up. So it's really good right now to preparing for what could potentially be a pretty bad recession, or at least a recession of some sorts going into the end of this year. So yeah, definitely with how boring today is, this could be a better time to talk about some of our strategies.
Yeah, I mean, you look at the S&P, and that 4,200 has been big time resistance. You could maybe, like, if you look at it, see a double top right now where we're on our way back down, potentially down to like the mid 30, mid 3K range. I think we'll see that sooner than later. But yeah, there's a lot to take into account when it comes to planning out your strategy during a recession. And that's what we're going to get into today. This is going to be the first time that a lot of people have been active in the markets during a recession. That was kind of when I got my come up in the markets, was back in 07, 08, 09. So I'm comfortable in it. And there are things that I learned that I think other people could benefit from. You're going to make mistakes when it comes to investing. You're going to have to learn lessons, but you don't have to learn every lesson on your own. Otherwise, things are going to be a lot harder for you. You're going to not make nearly as much money. So I'd love for people to learn from some of the mistakes I made, and us to kind of like get positioned so that we can all come out ahead when the dust settles, years down the road.
Yeah, absolutely. It's this is where all the money's made when it comes to the bull markets. People who take the right actions now obviously are going to be the most rewarded when it comes time for all the money to be pounded back into the space. So it's definitely tons of stuff that you and I could talk about today.
100%. That's what we're going to do. Real quick, we do have the CPI print tomorrow. Just to give people a heads up there, current median forecast is that it was flat, basically. So they're expecting core CPI to be up 0.4% month over month and 5.5% year over year. That's still not great. That doesn't give me any confidence that the Fed is going to pause interest rates. I think the markets are going to get absolutely pummeled tomorrow. I think inflation is going to come in maybe hotter than expected. And if that's the case, look out. It could be a very bad day. But do not, I'm not a trader, as I talk about all the time. I do not trade high volatility events like CPI prints, like Fed meetings. It's just too insane out there. So just something to keep in mind. We got that data tomorrow. But let's get into this recession survival guide, as we're calling it. I think first and foremost, we should give a higher level view on like some prerequisites before you even get into this. And a couple of those are just like general, like the really boring things that no one wants to talk about, but we should still talk about. So
Yeah.
first and foremost, like having a steady cash flow, like having money coming in that you can put into investments, having a budget and sticking to it. Like that is as boring as it gets, but it's so damn important, because you're not going to be able to make the most of your money if you don't know where your money is going. Okay. This is something that, my wife and I had to do when we redo when we had our kiddo and everything, because that's other expenses. So keep taking into account where your money needs to go, how much of it you got coming in, how much of it you got going out. There are plenty of websites and apps that make that process easier. So check out some of those. And then finally, we beat this dead horse all the time, but not carrying interest on a credit card that is accruing debt and that is compounding it. Like if you have one of those credit cards where it's like, hey, you don't no interest for 12 months. All right, I get it. Like don't let it get out of control. But if you're not paying off the full balance every time, I understand it. If you're accruing interest on a credit card, pay that shit off. Don't carry that debt. It's hurting your credit score. It's hurting how much money you're going to be able to put in long term. Just be smart about it because right now, like no investment at this point in time really is going to earn a rate of return that is going to be higher than the amount that you're paying on a credit card.
Yeah, that's a really good point. And I like,
like
a lot of, yeah.
If you're paying 20% on a credit card, good luck finding something where that money's going to be elsewhere and earn you a better rate. It's probably not.
Pepe, I'm just kidding. Obviously, it seems like all season's over. But you made a really good point about cash flow. I think cash flow is one thing that's really underrated, and I think that's really underrated for a lot of people who are maybe even younger. Because again, if you have the ability to have multiple streams of income, and going into a recession, you're way ahead of most people. Most people aren't even reacting at all to what's coming, or they don't even know that it's coming. So having multiple streams of income, you're not only protecting yourself against potential layoffs or anything like that, you're just having more cash on hand. You're able to live comfortably, and I mean comfortably. I'm not saying lavishly buying everything that you fucking want, but you're able to at least survive and also have enough money on hand to potentially invest at some point, emergencies, stuff like that. So yeah, cash flow is honestly one of the most important things that people just don't realize. And if you're young and you can work multiple jobs, you should absolutely be doing that. I can't tell you that really because financial advice, but you should be taking advantage of every opportunity to just generate as many income streams as you possibly can, whether that's passive or active, part-time jobs, whatever, side hustles, whatever it takes. I mean, that's my strategy. I have multiple jobs. I think it's working pretty well. It's been a 2-3 year process, but at the same time, it's like I know I will have cash on hand when the market drops. So it may not be the most lucrative looking strategy for the time being, but at the end of the day, it will pay off when you see that everyone else is not in the same position that you are because you did the work beforehand.
100%. You're gonna have to grind to make it through this. Back in 08, that was right when I was in school. I was playing cards full time. Quite honestly, like that, it was not the set. I mean, it was a fun line of work, and I made good money. But I also frequently took money out and invested in it in other areas. Whether it was Nvidia, which was one of my big wins. Like I had money going into the markets at that time, and I recommend you do as well. Like Kevin and I differ in some of our strategy along the lines of like. Kevin likes to watch the charts, try to find the bottoms, and then buy in. Me, I'm not good at finding the bottoms. I think most people don't have the time to do it. So I tend to DCA more than Kevin does. But at the same time, we can definitely agree on the strategy of having dry powder on hand to deploy into the markets. Because if you don't have any money that you can put into the markets when they take a big crash, you are missing out on huge opportunities. So let's talk about when to be defensive as well. I think for a lot of people, maybe especially on the younger side, being defensive isn't quite as necessary as older people as well, right?
Sure.
Like,
yeah.
I don't think you need to be super defensive if you're 25 years old and you got revenue coming in and you have a long-term time horizon. Now, for people who want to try to retire in their 40s, and if you're 25, it might be a little bit different. Maybe you need to try to preserve that capital a little bit more, let it grow for you. But I think you have to take that into account for sure. Is what kind of stage of life are you in? What's your risk tolerance, and allow that to kind of be the first stepping stone into where you're going to be defensive, or if you're not going to be defensive at all.
Yeah, absolutely. And again, it's wild because if you look at people who were trying to retire back in 2008, maybe they had their money in like a 401k or they had their money in the S&P, stuff like that. Obviously, it was a pretty bad time for them to try and retire because all their investments are pretty much dropped by 50 something percent. So sometimes you have to take action, and sometimes you don't. Being younger, obviously, we see that the S&P and these indices have a pretty good return rate, and they always go up after, some type of economic downturn. But yeah, but I mean, if you're short-term horizon, you want to retire, you want to live, the rest of your life on a beach or something like that, and the market's about to go into a recession and it drops, definitely you're going to have a different risk tolerance than someone who is, got time on their hands. It's all about time, in the markets. Obviously, you can either make money or lose money depending on how long or how little you stay in, in your positions. And yeah, obviously, it's going to depend on whatever age range that you are, like you said.
Yep, 100%. It's also, we've discussed before, the biggest returns in a lot of these market rallies happen early on, right? So you got to be trying to time the bottom can be really dangerous, because if it bounces and you don't have anything in there and you're trying to play catch up, you've probably missed out on a lot of returns. Now, I'm not saying that's going to happen anytime soon, but it's something to keep in mind. So there's that part of it. So let's get into kind of some of the ways to be defensive while at the same time setting yourself up for upside. Because when I say defensive, I don't mean moving everything into cash. That to me is not the best approach to take. But there are a few things, and we'll start with the most boring one, and that's going to be some of your fixed income options, okay? So in the past, people looked at things like CDs and, treasury notes as a good fixed income option. These days, I don't think that's the case. That money is usually locked in anywhere from, 6 months, like for CDs, like 6 months, 12 months. For, treasuries, it could be 2 years, 5 years. But in the past, that was the right way, because the interest on savings accounts was terrible. That started to change. We're starting to see higher yield savings accounts, which is a really great thing. There's a lot of options out there. Google can be your friend. There are, not like online banks like UFB Direct. That is that's one that when I was looking this up, that had a pretty good APY on a savings account, 4.81%. I'll take that. If you're a crypto person, you hear 4.81% and you're bored to tears because you see everyone getting, 8,000% on Pepe, allegedly. But for a savings account, that's a great rate. Superior to other form of fixed income, because you have your cash on hand as well. You can move that money into the markets if you see a dip. Whereas if you have a CD, if you have a treasury bill, you're going to have to wait till it hits, it matures. And then I know that it's boring, Kevin, but I don't think you're yawning when I'm talking about this stuff. All right. Like, I know it's not the sexiest thing in the world.
4%, really? That's it?
Yeah, I know. But it gives you a little bit of growth. It protects your money, and you're liquid enough to buy the dips when they happen. So I can move on past the most boring part, unless you have anything else you want to add to it.
No, I think that, again, this probably going to sound wild, but fixed income, some of these CDs and stuff like that, I don't think they're necessarily a bad play if you have a lot of capital on hand. Do you know what I mean? Like, if you want to preserve some of it, you want to safely guarantee that you're going to get 4% on something while you still have a good amount of cash, money on the side, cash that you could deploy at any point for liquidity. I don't think it's a bad idea. At least you're getting something as opposed to nothing, if, not being exposed to any of the market during these times. Again, banks have been pretty, some banks have been pretty crappy, even though the rates have been going up pretty high. But then there's some instances where you can get a pretty good return. Like the biggest one right now to me is probably Apple, right? Apple gives you a pretty good return. And, compared to some of these other banks, JP Morgan, the Bank of America's, not a bad idea. So
that segues right into what I was going to actually say next, which is around credit cards and like having the right one for that. So Apple is offering like what, 4.15% on their savings account, and you get cash back. You get 1% on your credit card purchases. It goes right into that savings account. That's a good option right there. To put a bow on, what you said about having capital and having some of these fixed income things, I think that's also huge if you're going to be in the market for buying a house. Right now, oh, here comes the kiddo. Hold on. Max is coming. We're going to add the kid to the stream. Here we go.
There he is.
So let's say you're looking at buying a house. My wife and I are looking to upgrade in the coming years, but right now I don't want a 7% mortgage. If you have been saving and you got cash that you're going to put into a down payment, but it's going to be a few years, put that into a fixed income. Put that into a 2-year treasury. Like, get something on that. Max agrees. Get something on that where it's not in like a risk-on environment, because you don't want to put your house down payment into something that is highly volatile. So put that into fixed income, earn a little bit of extra money. That's going to help with closing fees. That's going to help with home renovations, all that good stuff. But yeah, that's just my final thought on the boring world of fixed income options.
Yeah, no, I couldn't agree more. That's actually a it's a pretty good strategy there. And I think that's, again, with some of these crappy interest rates, and we're seeing how high the rates are right now for if you're going to take out a loan, it's not a bad idea to be making some money on the side for capital that you're going to deploy for buying a house. Again, I think that time is becoming soon, but like I said, we got to get to that recession point where the markets finally collapse, where we can start to use some of that capital to our advantage.
All right, sounds good. Let's move into some more fun talks. Let's get into stocks. So one thing that I see, a mistake I see people make, is being over diversified. I know that might sound crazy, but there is such a thing as too much diversification. You hear like, oh, you got to be involved in every sector. You got to be really well diversified. Well, that's also capping your upside, and that goes back to our discussion around where you're at in life, what your risk tolerance is. Can you tolerate to have a higher level of risk? So like Warren Buffett, for example, one of the best investors ever. He's for diversification, but in like a few things, right? Like, because you need to give yourself upside potential. So that would be one thing that I would say. From a positioning yourself standpoint, when we look historically at what's performed the best during recessions, it's been consumer staples, utilities, and healthcare. And those should be, a couple of those should be in your portfolio if you're trying to be defensive right now. So companies like Walmart, Home Depot, electrical companies, whatever, like those are going to be some of your more defensive positions, especially as times get tougher. Home Depot is a good one, in my opinion. Higher mortgage rates right now, people are doing more jobs on their house than they are buying new houses. And, places like Home Depot's, Lowe's, they stand to benefit from that. So just one example, not saying to rush out and buy either of those stocks, but those are two that I'd be looking at if I were trying to position defensively right now.
Yeah, absolutely. And again, with stocks, I completely agree when it comes to this over diversified thing. It's very easy just to buy everything because it's out there. You know what I mean? And it gets
Yeah.
to the point where, okay, if you're just buying name brands at this point and you just want to have them all be a part of your portfolio, uh, look where the market was back in October of last year, right? If you're buying, imagine if you're buying everything from Snapchat to, I don't know, Tesla to Meta to all these huge brands that are, people love to go crazy over. Next thing the market's absolutely hit the bottom of whatever this move to the downside was. We bounced since, but it's like, your portfolio probably saw an extremely bad 2-3 months there where everything was just absolutely red. So I think that over diversifying is pretty overrated. I think you just need to be good at a few things and really know what the markets and the industries in which you're investing in. That way you can easily say, okay, how is this going to be impacted by any news that's related to, point A to point B. So it's really interesting to see, like, not even really interesting. It's just like, it's smarter, in my opinion, to just know the topics and know everything that you're a part of, because it's easy to just buy, even if in crypto, you buy any random meme coins or, some of these, what was it? Play to earn games. Couldn't tell you anything about them, but everyone was buying them. And guess what? It was like one of the worst performing parts of my portfolio. So definitely make sure
that didn't go well.
Oh, no, not at all. What was that? No, October, November of 2021, right around there. Next month, everything was down pretty bad. So yeah, you just got to just know what you're doing, know what you're investing in. Don't be trying to win in every battle, because some of them are not your battle to fight.
For sure. And then that's kind of on the defensive side. Once again, though, you want to have a good growth position as well. So looking at things, right now, what I'm looking at are emerging markets, Brazil, India. I don't know if you could still even call them an emerging market because they're so huge at this point. But I think there's still plenty of value there, especially as they continue to grow and become one of the biggest economies in the world. So looking at emerging markets, emerging technologies, we've talked about AI being a potential dirty bubble, but that's still somewhere to look at. Electric vehicles, not just on the manufacturing side, but the suppliers of batteries or the suppliers of battery components as well. Those are areas that you could be paying more attention to, because we got a long way to go to increasing the amount of electric vehicles out there. I think it's going to happen eventually. That's going to require a lot of different pieces of the puzzle, and there's definite opportunities from that standpoint.
Yeah, I couldn't agree more. And I mean, there's tons of companies too where it's like, do you trust that the people who are in charge of these companies are going to be able to operate them in a way where once the economy starts to pick up again, are they going to be, the brands, the legacy brands that are going to, obviously perform well again? It's like, let's take Elon because he's probably the most well-known CEO in the United States, maybe even the world. It's like, do I believe that Elon Musk is going to be able to take Tesla and continue to guide it to 2030, 2040? Yeah, absolutely. I don't have I don't have a lack of trust or faith that the guy's not going to be able to perform well. Obviously, everything the guy touches seems to be turned into gold, but at the same time, it's like, is it in a market that I think is going to have really good growth? Absolutely. Do I think that there's good leadership behind it? For sure. Do I think that more people are going to be open to buying things from this company once the market starts to pick up again and they have disposable cash more than they do so now? Yeah, absolutely. So again, those are just a few questions you could ask yourself, and it's like, okay, are these would this be a stock or a company that I feel safe is going to grow and my money is going to grow with it?
That's a good point too on the leadership side. Something I wanted to touch on also. Taking some time. You got to do some homework, right?
Mhm.
Like this is. I know people don't want to put in the work sometimes, but looking back on what were some of the companies that really thrived during 08, 09, who were the leaders of those companies, and what are they doing now, and like what industries are they working in now, and trying to, or who are even like the C levels on those teams, and where are they, like just trying to find people who have been through this and who have kind of navigated these waters. What are they doing at this point? What companies are they with? Not saying you should buy all of them, but I'm a big believer in you invest in the leadership team as well behind a lot of these companies. So that's something else I would look at is, like, I don't love Meta, but Facebook was around during that financial crisis. Like they've kind of been through some of this.
Yeah.
Looking for companies that have leaders who have navigated the absolute shitstorm that can be a recession is a good place to try to diversify as well.
Yeah, definitely. They're probably, let's put it this way, Meta had a better chance of surviving a recession than FTX ever did. And that's
That's
saying a
for
lot,
sure.
right? Again, Facebook, what, 2005, 2004, 2005 it started, didn't start being publicly traded till maybe a few years later. Actually, no, it was much later, but you see how
Yeah.
it still survived prior to being public. Company was by itself and was pretty much ran in California, 2008, 2009, 2010. If you're able to survive that without having any like large funding behind you, the public funding, I mean, it's pretty good indicator that you know what you're doing.
Yeah. Let's get into crypto now.
Let's do it.
So this is, I know you were waiting for this part. I handled a lot of the more boring stuff. I'll let you focus more on the crypto side of things. What I will say is it's highly volatile, it's highly risky, but it provides outsized returns. So we have to talk about it.
Yeah, so is the banking industry, right? Highly volatile this year. Everything's pretty
That's
highly
for sure.
volatile. It's just, I think the thing
Yeah.
about crypto is people always assume that if you're investing in crypto, you're investing in the Doge, the Pepe's, the whatever, Turbo, all these other coins that are like blowing up right now. People think that's crypto. Obviously, there's a tier level to crypto, things that you can be investing in. There's obviously Bitcoin, which and Ethereum, which are considered probably the S tier if we're looking at the best investments that are similar to like the indices. And then you obviously have some of the altcoins that have been around for a couple of cycles. They have a pretty strong team. They have staking. They have tons of protocols where people are obviously using the network and the blockchain, and it has a purpose. So those are things that's a big difference compared to the meme coins that are slowly dying right now, if not already dead. But for crypto right now, I don't think that we are at the bottom yet. That's just my opinion. I haven't thought that we've hit the bottom since even the FTX saga. Like we were close, but we just didn't go down far enough where I truly felt that we were head bottomed. And right now we're seeing that there's tons of volume that is leaving the space, and we might see a little bit of withdrawals, but we're also seeing that the price is finding some pretty good resistance around that 30,000 level, very similar to how the indices are doing. So there's a few things you could be doing. For me personally, I'm short selling. Again, I don't know if this is the right time because we're kind of in the middle of a move, but I was selling at the top of that 31,000. I was just building positions. I thought that, the upside potential based off of how low the volume was was very limited. And again, Bitcoin dominance is also extremely high. So I thought if Bitcoin continued to push up and the dominance continued to climb, then altcoins didn't have a chance to, rise high enough to the point where you can get liquidated. So I'm short selling. I think that was probably the best move for the time being. Obviously, the market's pulled back since a little bit. Do I think there's a little bit more? Sure. And again, you have to also think, what's your time horizon? Like some of these, I'm obviously going to take profit and I'm just going to trade. The ranges, probably going to see a bounce at some point. Maybe I go long, maybe I just hold a cash position until we get to another point where I feel that we could potentially short the market again. These are things that you can keep in mind. And also, are you scalping or are you doing this long term? Are you trying to catch the absolute bottom and ride this all the way down? Are you trying to take Matic from, where is it right now, 87 cents down to 30 cents so that I win this bet with JWeb? Okay, that's one question you could ask yourself. Or are you just trying to take it down to 76 cents where, hopefully that's the next level of support if it does fall, below this support right here. So it's really interesting to think about what you're trying to get out of short selling. But also with crypto, I think there's also a really good thing that's you could potentially be doing, which I think JWeb does pretty well. And that strategy worked extremely well for him during that short squeeze that we saw back in January all the way until April, was to DCA at some of those levels. Like he bought in, what did you buy in? Like 15, 16K, like around there. And then
For Bitcoin?
For Bitcoin or ETH. Like I know you were buying at that time.
Yeah, I was buying Bitcoin between 18 and 20 last year. That's played out pretty well. I was buying ETH around like the $1,400 to $1,500 level, even actually lower than that, even back in like June. But for me, that was just, I DCA, and there's a few different ways to do it, right? You can set up like recurring buys, which I've done in the past. I did that for a few months when some of my favorite tokens like Link and Matic were at low levels. I turned off those automatic buys when they started to get, a little frothy. Or you can have cash on hand. Like my current DCA strategy is going to be, I have some price targets for ETH and BTC. When I see ETH get down to about, I'll deploy my first chunk at around probably 1,600. If we get down to 14, I'll do another one. If we get down to 12, I'll do another one. I'm not going to probably catch the absolute bottom, and that's okay with me, because I don't have, like, looking at all the charts and trying to do all that stuff is not for everybody. It's not for me. That might be for Kevin. It's not for me. So that's going to be kind of my strategy, and I'll have similar levels set for Bitcoin. Those are going to be my two biggest ones, and I'll continue then to add to my Link and my Matic positions as well. And those might be a thing where if they take a big leg down, maybe I'll turn those automatic buys back on. It wasn't a ton of money, a couple $100 a month, but at those lower levels where I think those two particular coins are going to go in the next bull market, I just want to accumulate.
Yeah.
And if I don't accumulate at the absolute bottom, that's okay. I would just rather accumulate at, prices lower. Like I think Matic could go somewhere like $5 to $10 someday. I think Link could go back up, hit new all-time highs above $50. So I'll risk, missing the absolute bottom if it just means I can accumulate more for when the next bull market happens, whenever that's going to be.
Absolutely. And that plays in well with, again, having cash on hand, because having that cash on hand, you want to accumulate at the bottom and not at the top, or at least somewhere at the point where
you're don't do the Michael Saylor strategy. Don't be buying Bitcoin at peak enthusiasm.
Dude loved $69,000 Bitcoin. Like you just loved it. I think his company hated him for it, but yeah, it's, you have to have cash on hand to buy some of these in order to make the most amount of money in the bull run, right? And you want to accumulate at the right time, because if you're accumulating somewhere in the middle or somewhere at the top, your upside is extremely limited. You're also hurting your buying power, right? You want to have the most amount of buying power to get into the market. You want your money to do the least amount of work. So that means you're probably going to be riding the first wave up with a lot of the people who are smart money, big institutional players. Those are the guys who are buying at the bottom, and then, they're DCAing out of the market towards the top. That's not the case what we're seeing right now. We're seeing obviously manipulation. So those guys are telling the exact top of the market. They've created it. But when we're in a bull market, obviously there's a lot more funds flowing around, and you're getting everyone from retail, from just retail all the way up to institutional players, adopters. That's when you're going to probably see the most amount of gains. It's going to be in those first few pushes to the upside, right? And right now, I don't think that we are in that position. I think that a lot of the market is kind of hopeful on the fact that we're just going to keep pushing up. I don't think anyone's missed anything really. That's just my opinion. I could be wrong, right? I am open to the fact that I'm, 50-50. Either I'm right or I'm wrong. But I'm pretty sure that I'm not fucking wrong on this one. Again, I just don't see the volumes picking up to the point where it feels like we're in a bull market. That looks like we're in a bull market. The volumes are much lower than we were back in even some of the bull markets before, Jerome Powell and the Fed decided to start running that money printer. So it's really weird time right now, but I think that there are a few options that could potentially get you set up for the point where when that bottom comes, either you've made money shorting the market because you don't necessarily need to be buying stuff to then short it. You could just, short sell it. You're borrowing and then selling those assets to buy back later and you keep the difference. Or you just are working, you have cash on hand and you're going to DCA all the way to the point where you feel these levels are the right levels to be getting in for accumulation. So there's definitely some strategies to survive and not hurt your capital. I hope you are not absolutely holding on to everything from 69K all the way down to whatever it is, 10K to wherever it might go. If it was, you might have bigger balls of steel than I do and just a larger, frame of view when it comes to the macro outlook. But yeah, because anything could happen. And again, I think today is actually the anniversary of Terra Luna. I think it is today, or the one.
Right around it. Yeah, like
Yeah,
today's the anniversary of the famous Steady Lads tweet. I
that's
don't
what it
know
was.
how
Yeah,
how close to that it all went down, but yeah, just have cash on hand. There's a reason they're called Black Swan events. Like you're not going to see them coming, but when they do, you want to be able to try to buy the bottom because look at just in the last year, if you had bought near the bottom of last summer with Terra Luna and Celsius, you made good returns.
mm-hmm.
If you had bought near the bottom of FTX when that all collapsed, you're still sitting on a good return. So when everyone else is panicking, have money on hand and act with conviction. Okay, I think that's a good place for us to wrap it up for today's show.
Yeah, couldn't agree more. Have conviction. Don't also don't buy into what other people are selling you. Obviously stand behind what you believe in, and hopefully, if it's educated and you've done your research, you've done your homework, then you're going to be on the right side of things.
All right, that'll do it for today's show. We appreciate everybody who watched. Hit that like button if you did not. Drop a comment, kind of give us what your thoughts are heading into this bear market, this recession, all that good stuff. We'll be back tomorrow, same time, same place. And CPI print in the morning, expecting to see some volatility there. Very interested to see how the markets respond. So that'll wrap it for today's show. Thank you, everybody, for watching. Kev, see you tomorrow, everyone. Have a great day.
Take care, everyone.